On this small business Saturday morning, and you don't realize because we think of coffee shops and antique stores when we think of small business Sunday, but realtors are small business people as well. And Cynthia Hash, as she nods at me, acknowledging, I feel like I did back in high school when I would get an answer right. She is here from Find Homes Realty, a small business here in Central Virginia. Happy Small Business Saturday, Cynthia.
Happy Small Business Saturday to you. I hope you had a wonderful Thanksgiving.
Oh, yes, I'm still, are you kidding? I may nod off in the
Yeah.
middle of the program, and it's not because of you, it's still because of the built-up tryptophan. So,
Oh, that's it. That's it. You probably, you've at least had one sandwich or two of,
I will
you
guarantee
know,
this is more interesting than at least one of the football games on Thursday. So,
yeah. Oh man.
but while
Well,
everyone nervously awaits the Commonwealth Clash football game tonight, did you see? I happened to notice, as conveniently right before the Thanksgiving holiday, it seemed like the third quarter numbers started to come out real estate wise. What are
yeah.
your thoughts on some of that?
Kind of rolled right in, didn't they? I'd like to start with state of Virginia and
Sure.
the research statistics over there because it kind of includes, our areas are getting because of the internet, because of everything that's going on in the world and so
Hmm.
forth, the world keeps getting smaller, right? And so, so I thought I'd go over the state of Virginia
Yeah.
first, and if we have time, we'll go over the greater area of Charlottesville and Augusta. But I think this is very interesting. I think you'll find it interesting. The um, the key takeaways that I see here is that, and this is October 2025, okay, because they're always a little, some time behind because of putting together all these statistics.
Hmm.
But they do a really good job of it, I think. And in October, basically home sales continued in an upward trajectory. Not crazy, but still upward since the summer a little bit.
Okay.
But there were nation, not nationwide, but statewide, okay?
Okay.
And there were over 9,000 closed sales across the Commonwealth of Virginia, 274 more sales than there were a year ago. And that's about a 3.1% increase.
Wow. That's
Hmm.
a that's a decent number. And I don't care what business you're in. If you've gone up 3%, you can pat yourself on the back and say we're doing okay.
Yeah, I think so too. And the additional kind of tidbits were that home prices went up in almost 6 out of the 10 local markets in Virginia. And so the statewide median sales price was about 430, and it went up about 15 grand since last year.
Hmm.
And again, that's 3.6% increase. A combination of maybe higher sales, okay, and rising home prices, that led to a significant increase in sold dollar volume. So there was about $4.9 billion sold volume throughout the state of Virginia in
Wow.
October. Yeah. This was about 400 million more than the same time last year, and that's an 8.1 increase, 1% increase, 8.1. So I think at the end of October, we were looking at like 25,000 more active listings, a little bit more than that,
Hmm.
on the market across the state. And this represents about a little over 5,000 more listings than last year. That in and of itself is a 25.7% jump in inventory levels.
Wow, a full quarter of a so you talk about the balancing. I think you talked about this last week that the market is kind of coming back into a
Mhm.
balanced place. Is this what's feeding it? That we're
Yeah,
getting more inventory and we're
that's it.
still seeing a few more buyers, but not as many.
That's it. That is the secret right
Hmm.
there. Um, I think when it's more stable, then the properties are more available. Buyers start to come out
Okay.
because a lot of times, they'll come out and they'll think, well, maybe I can get price reduction, or maybe I can uh, get a full-on home inspection without having to compete with somebody else and,
Right.
having an as-is home inspection or something. Or maybe, those kinds of things. So kind of like what we were talking about last week and the week before,
Hmm.
about price changes, price improvements, price decreases, whatever you want to call it. That for buyers and sellers, kind of take a look at
Right.
that. But yeah, everything seems to have been up, including the months of supply. Okay. So when the months of supply goes up, that's when the market starts stabilizing a lot.
Where are we at now?
So in months of supply in the state
Yeah.
of Virginia, it is roughly 20, it's changed about 22%, so it's a little bit higher.
Hmm.
So you figure, the months of supply right now is probably close to 3 months in
Okay.
Virginia. But in the like in the Charlottesville, Greater Augusta, that kind of area, the months of supply is actually a little bit higher even. So you're looking
Wow.
at probably about 33, almost 34% year over year change. So we're looking at almost 4 months of supply
And for
in,
reference, you've
Mhm.
told us in the past 6 months is considered balanced.
Yeah, between 4 and 6 months.
Okay.
Yep. That's considered balanced. So we're really close to being right in that sweet spot of a balanced market, a what we call a stable market.
And that means, both buyers and sellers have, their own upside, but
Mhm.
neither is dominating the other, correct?
Well, correct. And the other thing to think about too, though, is the fact that we are in a position in the Charlottesville on the Charlottesville side of the mountain, okay?
Hmm.
The pending um the number of the median list price and the median sales price, I'm going to tell you, there's a difference now. Yeah. And the median sales price is like 3.2% and year over year, whereas the median list price is 5%. So you're
Oh,
about 2% off here, to where now what's happening is the median list price in the Charlottesville in Greater Augusta area is about 499,000. Okay. So
wow.
if it's 499,000 and your median sales price is only 490, we're on that trajectory now
Okay.
where
Now
prices are coming down a little bit.
this goes into what you were talking about last week and the week
Hmm.
before about, making sure you price correctly so you're not
Yes,
necessarily having to do a lot of price adjustments down
that's
when
right.
you're trying to sell a home, and what you're looking
Hmm.
for when you're trying to buy one regarding prices that may be
Hmm.
higher than you want.
That's
Correct.
exactly right.
Yeah.
Yeah, exactly right. And I think what's
See, I'm paying
happening,
attention here. It may
you
not
are
look it,
paying
but.
attention. Way to go, Joe. That's awesome. I hope everybody else kind of is getting,
If I can, everyone else
absorbing
can.
some
All
of
right.
this.
No
Yeah.
excuses. If I can
That's
do it,
the,
anyone can do it.
oh,
That
you're
was
so
my high
silly.
school career.
No.
So that 499 is an
Yeah.
eye-popping number when you're talking about
It,
average list price.
Correct. When you're looking for the state of Virginia, the entire state, the median sales price is about 430.
Okay. All right.
So
Still.
there's that difference.
Hmm.
So you figure Charlottesville still is up in the top three most expensive places in the state in which to live.
Yeah. No,
So
I see
yeah,
that. I
yeah,
see that a lot.
exactly.
And that includes a lot of areas around it
Hmm.
because, as Charlottesville becomes restricted, just the way Stanton and Waynesboro become restricted, you can only put so much in there. Waynesboro's a little different. They're finding creative space, and there's a lot of space in Waynesboro that they're purposing for
Yeah,
housing. But Stanton, like Charlottesville, has only so much land left for houses to be put on it. So you
yeah.
start to look into the hinterlands. What is Stuart Straff doing? What is Riverheads doing? And those kind of things,
Hmm.
just
Hmm.
like Fluvanna and Crozet and places like that.
Yeah, well, you figure you're going to have real estate is typically hyper local.
Hmm.
And so it depends on every single jurisdiction every single county, every single city. It's very hyper local,
Hmm.
and you can figure the difference between, let's say, like the market activity in Greene County. It is booming there. It's like 41% increase
Oh my
in total
goodness.
sales. It's
Wow.
booming in Greene County. Yeah, it's amazing.
Is that proximity, and I know it's hard for people who have driven it, but considering its proximity to Washington, D.C. in that area,
I think it has a lot
Arlington,
to do with that. It has a lot to do with NGIC and DIA,
that's true
and
also. Yeah.
yes, exactly. And then I don't know when AstraZeneca or whatever it is going to be
Hmm.
coming in. The pharmaceutical, I think, is going to be coming in the on that campus, right next to that campus there at
Yeah.
NGIC. And of course, the people that you can tell when they're not from the area, they call it uh, Rivana
Yeah.
Station.
Yeah. They softened the A. I was
Uh-huh.
guilty of that. I
We're like
called it
Ravana.
Rio Road. And yeah, of course.
Exactly.
You're not from around here, are you?
No, yeah.
That's it.
Well, the
So let me
only
ask you.
county on the Charlottesville side of the mountain that actually had a decrease in inventory was Nelson County. Everything else had an increase, like to the tune of, I kid you not, in Nelson County it was a negative 3.5% in
Inventory.
inventory. Okay, Greene County had a 76, almost 77% increase in inventory.
Now, is that building or is that just
I
existing
think it's
homes coming up?
including everything. Yeah,
Okay, yeah.
it's including everything. But anyway, I think that was some interesting stuff. I do have another topic that I would like to go over. I think I just briefly went over all this. I want to make sure that you know how to get to us though. You can go to findhomesusa.com
Hmm.
and see these kinds of reports. Go straight to the market report tab
Okay,
and you can see those kinds of reports. Go to
awesome.
findhomesusa.com and straight to the market reports tab.
Very
So,
cool.
yeah, so have at it if geek out on it if you want to. It's all there.
Well, and see if you find something in there and then email Cynthia and say, "Hey, I was looking at the report and this doesn't make sense to me," or
Yeah,
explain this to me because that's what Cynthia likes to do is explain this stuff to us. That's why she does these radio seminars each Saturday morning
that's
for us.
about right.
No, I mean it's really, I mean it's because if you know, you know, and you may find yourself needing to sell your home, and then you have some at least some yardsticks to look around before you call Cynthia, which is what you should be doing anyways, calling Cynthia.
Thank you so much, Joe. I
Um,
love it.
so what about the news story? And I
Yeah.
know it kind of caught some headlines, this idea of a 50-year mortgage.
Yeah, it did. And I had a chat with Jamie Yell at Bank of the James, and he couldn't make this episode, but he was able to give me some insight on this hot topic. And basically 50-year mortgage. I'm sitting here thinking,
Wow.
just if I'm looking at like, have you even looked at this amortization schedule? You know,
No, I don't even, and I know what an amortization schedule is, and I can't even imagine what one would look like for a 50-year mortgage.
yeah, I don't think it's would be helpful at all. But personally, anyway, I think it's just, I don't know. I think it was a reach, something that maybe some people would like to
Well,
do, but
here's
I
here's a
wouldn't.
question just to be the devil's advocate. I can imagine the same thing was said when somebody said, "Hey, what about a 30-year mortgage?"
Well, they might have, yeah, because back in the day, there at one point there used to be only about 15-year
Right.
mortgages, because that's when your house payment was, $300 a month.
Yeah. Your car payment isn't even that anymore.
No, it's not. No, absolutely. But there's been so much talk about this like 50-year, mortgage and a lot of emotion on both sides given to this type of topic.
Hmm.
And I think this is I think this is always where it lands, and that is you need advice and you need guidance.
Hmm.
And it's not just purely interest rates, and it's not just purely the price of the home. You need all the information to make a very informed, educated decision.
Yeah.
And if you're working with a trusted team that I can put together for you, uh, then we're all acting in the client's best interest. We all have their best
Hmm.
your best interest at heart. And so that's still going to be the best way that you're going to get served is build your team first. But
Sure.
here's this thing. There's no known facts yet about a 50-year mortgage. So we
Yeah.
haven't done this yet. There's nothing set up yet, so don't get too excited about it. But anything that you see that's kind of stating it's fact from others is purely opinion, really,
Hmm.
since there literally is no official program that has been announced about this, none
Right.
yet.
There's no product out there. You can't go to Find Homes Realty and or whoever it might be, BB&T, and say, "I
Mhm.
want your 50-year mortgage."
Yeah, no, because nobody's set up for it yet.
I'm sorry,
Um,
Truist. Somebody just said
tr
said there is no
Truist, yeah, I knew
BB&T
who you
anymore.
meant.
It's Truist. Yeah.
I knew who you meant. Uh, but there's some possible advantages, and that would be three basic ones, right? And that would
Okay.
be a lower monthly payment.
Hmm.
That's the goal,
Hmm.
is try to make it more affordable. But what you're having to do is you're stretching out the repayment period. So the principal and interest, the P and the I, though that payment drops. And so, for example, you have a 500 year, excuse me, a 500,000 house that you
Yeah.
purchase, and the principal and interest might drop about $320 a month in one scenario compared to a 30-year mortgage, right? So so what this assumes is basically the same rate, 30-year mortgage, 50-year mortgage, but that may not be the case. In other words, if the 50-year mortgage has a higher interest rate, then your monthly savings will actually be lower,
Oh,
right?
yeah. I hadn't thought
Yeah.
about that. Yeah. You
Yeah.
presume things are equal, but not
It
necessarily so.
might not be when it pans out. And but this can also help with basically if you have a tight cash flow for maybe a higher debt burden or anything like that, maybe in order to
Hmm.
qualify, what it might be is kind of nice to have temporarily. And
Oh.
so you might be able to get a slightly more expensive home while keeping the payments manageable, right? So the second most, you know, outstanding thing that could be a possible advantage would be the potential for increased buying power. So like it would be considered like an entry tool, okay? Because the payment is lower. Some buyers might qualify for a loan they might not qualify for with a 30-year mortgage.
Oh.
So yeah, so it could be maybe relevant in like a really high cost market area
Mm.
where monthly payments
Charlottesville.
are yeah where the burden is pretty daggone high all the time,
Yeah.
or it actually could be used to help buyers in during the underwriting process,
Okay.
and
All
and
right.
and maybe their income, their bonuses, etc., and so forth doesn't qualify for a 30 year, but it
Mhm.
can qualify for a 50 year and get them to closing, and then they can
You
refi, a year later or something.
in just describing that, you made me think of USDA
Hmm.
because when you look at USDA mortgages, and that's mostly for outside of the urban areas,
Hmm.
but you're also looking at the area where, in my experience, it's been like, hey, you don't maybe have the greatest credit score. Let's look
Hmm.
at USDA loans.
Yeah.
Is that a place where, maybe even beyond banks that you'd see a USDA kind of roll out a 50-year mortgage?
You never know.
Yeah.
It could be anything. I think it would end up having to be something where the government mortgages in some way are involved,
Mm.
because you figure Fannie Mae, Freddie Mac, they buy mortgages and stuff like that, or they're backing mortgages and so forth. And when they're doing that, they're the every all of the mortgage brokers,
Hmm.
okay, have to follow their regulations. So the regulations
Sure.
don't exist right now about a 50-year mortgage. They just don't.
Oh, right.
Yeah.
No
Yeah. And
guardrails.
no, exactly. That's exactly right. And so the third thing that it might be a possible advantage would be flexibility and maybe an alternative strategy of some sort. So basically, the mortgage lenders would possibly take uh, their look upon this might be like a foot in the door as
Hmm.
type of strategy. So buy now with the lower payment and then either refinance for a shorter term later to buy an extra principal when it's possible,
Hmm.
when you've got extra principal possible, or when
You
you've got extra
become,
equity.
more
Mhm.
income in your home.
Or
Yeah,
more
that kind of thing.
income.
Yeah, all right.
That's exactly right. Yes, that's exactly right.
Mm.
And if you do all of those things, then those are probably the possible advantages. The other thing that uh, Jamie was talking about was at, and again, I'm getting a lot of this from our conversation, Jamie Yall at Bank of the James, and so some of the possible disadvantages, so not so great. They kind of outweigh, I think. But right now, it might not be a bad idea. But let's talk about the disadvantages. Number one, much higher total interest cost. So since the loan lasts 50 years, you have a lot more interest that accrues over that 20 more years. Okay.
Yeah.
So yeah, and so you look at the analysis and the estimates and the amortization schedule and so forth. Think of it this way. You have a $450,000 loan at 6.125%. For a 50 year, you end up paying, okay, $996,000 in change.
Oh my gosh. You're
Yes,
functionally
in just
doubling the price of
interest.
the house.
Yes. And then,
Wow.
yeah, and and that, for a 30 year, you're about for a $450,000 loan, the interest on that would be about 534,000 for 30.
Hmm.
It's still a lot,
Right.
it is what we're used to, but what we're not used to is the inflated prices of real estate.
Hmm.
So no, the second thing that are possible disadvantages would be a slower equity buildup. So if you have so early payments, long-term amortization, they usually go to mostly to interest.
Hmm.
And so the principal reduction is very slow.
Hmm.
So on a 50-year term, that meaningful equity may take much longer than a 30-year mortgage.
Yeah.
So
No, I
yeah,
could see that.
yeah. The
Well,
third
especially if
thing,
you're thinking, I mean, I was thinking, you know, a 25-year-old is going to be 75 by the time this mortgage is done. So your equity buildup is important to think about in that.
it really is. It really is.
Yeah.
But if it got your foot in the door, okay, and you needed to, and you're going to sell in a few years,
Mm.
and you're kind of gambling on that equity still being there, so you can pay the expenses of doing business when you sell,
Hmm.
then maybe. But the other third thing I think is this extended time, that you're carrying this debt. So the term is so long, like you said, like you're 25, you buy your first house and you don't pay it off until you're 75. So some borrowers, will pay well into their retirement years, and then it poses a risk if income drops.
Sure. Yeah. I mean,
So,
obviously, the upside is if you get into a house and then your income goes up, you can refinance to a lower,
yeah.
yield. But what if the opposite happens?
Well, and it could, but so this is why if you're trying to, you get in, maybe you don't want to refinance, you don't want that obligation.
Hmm.
I recommend that you pay as much as you possibly can on your principal every single month. So
Yeah.
you not only pay your principal and interest payment that you have to pay. The one good thing is that this would be something that would be, you could still have a fixed rate, so it wouldn't be the adjustable rate mortgages that went crazy,
Oh, yeah.
20 years ago. But the main thing here is to think, strategy.
Hmm.
Think strategy.
How
And
do you
when
mean?
you, well, because if you are, you gotta, it's almost like you almost have to have a crystal ball. I you know, so you have to strategize based on, okay, do I have life insurance? For let's say there's, a married couple and do I have life insurance on each other? Do you have that? So that in case one person passes away, uh, pay down the mortgage principal, what by that much. And then then maybe even refinance
Mhm.
possibly. So just strategize, and I think that's one thing. If home values decline, that worries me a little bit because you've got negative equity at that point, and then it's crazy, and it becomes a little bit too risky, in my opinion.
Well, that's kind of
But
what
then,
happened in '07, '08. Is people wound up
yeah.
underwater in their houses.
They did. They did.
Yeah.
So the other thing is, but there's a potential for inflation of home prices. So there's kind of it's like a affordability paradox where the lower payments alone won't fix the underlying basically supply constraints. So you're increasing borrowing power without increasing supply, and it could push
Mm.
home prices higher. Yeah, who
Wow,
knows?
yeah, that's
Uh-huh.
inflation.
That
Kids,
would
kids,
be.
if you're wondering how inflation works, Cynthia just explained it to you.
Yeah, that's right. So then that would end up offsetting the whole idea of it, right? And so some experts, actually argue this type of loan may kind of actually shift affordability rather than actually improve it in because it's not really sustainable.
Hmm.
And then the fifth reason for maybe a negative would be the regulatory underwriting and uncertainty.
Oh,
And a higher interest rates might be likely
hmm.
because it's bigger risk for the banks.
Oh,
You know?
sure.
Yeah,
50 years? Are you
it's
kidding?
huge risk. Hmm.
Banks don't stay without merging for more than 50 years these days. I mean, Bank of the
True.
James is outlier to that, but most
Yep.
of these banks they've merged 5 or 6 times in those
Yeah.
50 years.
Yeah. But and then the fifth one, big one here is that we're talking about, like, with Fannie Mae and Freddie Mac, like I mentioned, they have regular 30-year maximum conforming terms, and you have to go with those, et cetera, et cetera. All that's going to change, and then you
Hmm.
have to compensate for longer term risk, which the lenders have to figure out, and I think it's just going to be a mess, to be honest
Hmm.
with you. But anyway, the possible math, that's the big one that everybody wants to know about, is the math part of this.
Of course.
And yeah, and so it's unknown right now, but the 50-year, where that's going to come in, and is it going to be able to offer the same rate? If it offers the same rate, it might be very good, and that would be very helpful. But I doubt it. But if the payment is very simple and similar to a 30-year mortgage with maybe a 1% lower interest rate, for example, I don't know,
Yeah.
there might be a better payment option to lower the payments, maybe. But it takes upfront money to buy that down usually.
Hmm.
So yeah. And then of course you've got equity building. So the math of this would be, let's use 7 years, for example, which is a roughly an estimated average time at which people own a property and turn around and sell it. That's usually the turnaround time.
Really? I'm
Yep.
sorry, not to drag you on a tangent. I didn't realize it was
Yeah,
that
yeah,
small
it
of a
is.
number.
Yeah.
Wow.
So you take a $500,000 home, okay, on a 30-year mortgage, it'll have approximately 112,000 in equity at the end of 7 years, let's say. And
Okay.
then this is through principal pay down and using the 3% average appreciation. So a $500,000 home on a 50-year mortgage will have approximately $72,000 in equity at the end of 7 years. And this is principal pay down using 3% average appreciation. The difference is about $40,000
Wow.
because less principal is paid on the
Hmm.
50-year mortgage during that traditional amortization schedule.
Right. So you're losing out on that equity
Yeah.
because you're still paying that interest.
Yeah, you are. Yeah, exactly. So, but you got to
Wow.
look at the rent comparison. If the rent is $2,500 a month, okay, over 30 years, that equals about 900,000. And there's
Mhm.
no equity, no asset owned by the
Yeah.
person who paid that. Okay. And this doesn't take into consideration any kind of rent increases that always happen.
Oh yeah.
Uh-huh. And as you know, we all know that. So it's way more likely that it's going to be over 900,000. And then you have a 30-year mortgage
Mhm.
would have cost 993 in this particular example, 10% down, let's say 50 on a $500,000 home. So the asset would be owned for retirement. This does not take into consideration the appreciation, which could significantly increase the value of their assets. So you got a 50-year mortgage on the other side of this, and you have, listen to this, $1.5 million as this exam for this example. So you have 10%
Wow.
down, let's say. Yeah. And then you have rent over 50 years would be about 1.5 million ish.
Ooh.
Yeah. Uh-huh. Yeah.
So
So what
it's
do
a
you
hit.
do?
Yeah, there are upsides to it, and this is why you want to talk to somebody like Cynthia. Well, enjoy the remainder of Small Business Saturday. I hope people come and
Thank you
visit you
much.
for that, and we will talk to you next week.
Okay, you take care.